accepting the truth is the first and most crucial step towards your debt payoff journey. We must admit that we owe significant amounts to various organizations. Whether it is student loans after graduation, credit card bills, auto loans, or personal loans, most of us have much debt to pay back. In this video, I will make this process much easier for you by discussing some strategies that can be your go-to for debt payoff. But before we proceed with debt repayment strategies, you must clarify that debt can be good or bad. Whether you are an individual or a company, your financial performance relies on the timely repayment of your receivables. So what will you do with the bad debt if paying back that deferred revenue becomes impractical? In general, bad debt is a form of expense known as an irrecoverable receivable that happens when a client you have granted credit to is either unwilling to pay it back or can no longer do so. In terms of accounting, you can call it a bad debt expense, and it must be deducted from the accounts receivable of your business. Hence, bad debt impacts your cash flow and financial projections because the expense for bad debt lowers the worth of the accounts receivable on your company's income statement. Also, other companies in your ecosystem may suffer financial harm. Contrary to bad debt, good debt can help you become a millionaire. All you need is effective planning and strategic execution of your investment plans. However, the key is to keep your money in a continuous investment cycle. Before you proceed with investment plans, focus on clearing your bad debt. Yes, paying off your bad debt is the first step, as it affects your credit score. A credit score is a number representing the credit worthiness of an individual. Simply put, credit score predicts the credit behavior of a person and how likely he will return loans. Banks and various other financial organizations use this credit score based on your credit reports to lend you money. Thus, it is really important to maintain a good credit score. And a good credit score means no bad debt. Well, there can be multiple reasons for a bad debt, but in most cases, the person can no longer pay it back because of bankruptcy or solvency. Generally, it just takes a few months of extra expenses or unemployment to get into a vicious cycle of bad debt, but it takes much longer or even years to pay it off. Before I proceed with repayment strategies, keep in mind that slow and steady wins the race, requiring strong commitment and consistency to get to zero balance position. Number 1. Record keeping of your debts. It can be tricky and challenging to be in a bad debt scenario, but it is crucial that you write off your bad loans though. Simply put, writing off a bad debt entails admitting you have suffered a loss. People often confuse debt record keeping with bad debt expense, which is a technique for accounting for potential losses in the future. It's crucial to account for bad debts while doing your bookkeeping. The tax laws that apply to you may occasionally vary based on how much bad debt you have accrued. Record keeping is challenging. Missing out on even a minor detail can result in miscalculations and faulty analysis. Moreover, this task is disliked by many and can be frustrating at times. Some people also feel stressed and pressured when they write down huge amounts of debt and can't see any way to pay it off. Consider hiring a bookkeeper for this job. It will add up to your expenses and you may feel it burdens your pocket, but trust me, once you try keeping a good record of your debts, you've already taken your first step. Number 2. Listing out your debts and analyzing them. Now that you have a good record of all your debts, your next step should be to analyze each debt. Things that you may consider in this step include to whom you owe that debt, the interest rate of the debt, how much of your monthly income will go to the repayment each month, and how much time you will need to pay it off. Calculate all of these details for each debt, and then you can rank them according to your priority repayment order. Number 3. Debt Avalanche versus Debt Snowball strategy. Where to start paying off your debts can be a confusing and difficult puzzle. According to a strategy known as Debt Avalanche, one should consider paying the most expensive debt with the highest interest rates on the first go and then gradually going down the list. If you follow this approach, allocate extra cash or expenses to repay the largest debt. At the same time, the Debt Snowball strategy allows you to repay smaller debts before moving towards the more expensive ones. Generally, it is easier to pay off smaller debts and motivates you to go ahead on your debt repayment journey. Both techniques are effective in their ways, but which one you opt for will depend on your financial situation and many other factors. But if you ask me, I recommend the Debt Snowball strategy because getting rid of smaller debts is easier and faster than bigger ones. Then you can focus on others. Number 4, make more assets than liabilities. Once you get out of bad debt, Building on your wealth is the next step. Yes, you can get rich with good debt. Contrary to bad debt, which you grant to someone, good debt is when you use it to buy an asset that gives you positive cash flow, like home loans, rental properties, etc. But ideally, you must clear your bad debts first, as it will become a lot easier for you to get a good debt if your records are clear from any bad debt. Most of the time, people think they are investing in assets, but buy more liabilities for them. Let's draw a clear line between assets and liabilities. Simply put, if an investment gives you more money in return, it is an asset. But if an investment takes money out of your pocket or you need to spend something on that investment, it is your liability. If you want to get richer while paying off your debts, focus on building more assets than liabilities. Let me explain with an example. Buying a rental property is far better than expanding the amount on improving your current home, the one that you are living in. In this case, if you are considering the first option of improving your home, it will be your liability, as you have to spend a good amount on it, and it will not return you anything. Now consider the other option, which is purchasing a rental property instead. It will save you money and pay you some dollars by the end of each month, so it is an asset. Number 5. Boosting your passive income. BRRRR Method. When it comes to building assets, I can't suggest you any better option than real estate investment. It can return good profits, but it can be risky at the same time. So, what strategy should one adopt to start real estate investing? The BRRRR strategy. The BRRRR strategy can be your go-to approach if you are planning to invest in real estate. The acronym BRRRR stands for buy, rehab, rent, refinance, and repeat. And this strategy has made many millionaires already. The first step is buying a property that can be a good investment. You must do market research, for which you can also take some expert advice to explore the best options. The second step is rehab, which is about improving and upgrading your rental property. When you have purchased a property, you should think of ways to make it livable. While doing so, ensure that you are only spending as much as you can get back from rental payments. Avoid making excessive upgrades, because we aim to build assets, not liabilities. Once you have completed the rehabilitation process, your property is ready to rent out. This property will now add income to your pocket every month. When your property produces a consistent income, you can ask your investor for refinancing. Some organizations give you extra finance for reinvestment, while others allow you to clear any outstanding debts. But in any case, it is going to benefit you. The last step of the BRRRR method is to repeat the whole process. Once you go through all the above steps of real estate investment, you'll love the process and can't wait to repeat the cycle. Follow the steps and start building your second, third, fourth property, and so on. So, do you have more good or bad debt? And what do you plan to do about it now? Let us know in the comments below. Thanks for watching.